everyone.
Go for it.
Hello, everyone. Welcome to episode 3 of Dalan and Michele.
What's going on, everybody? Happy Sunday night to you. The problem is there's so much comedy just before we go on. It's like I'm trying to decide like what level of serious to switch back to, but let's make it happen.
It's all good. Welcome. Thanks so much for joining us tonight for episode 3. We are excited about this episode, and this episode we're talking about processes from a keep your stride perspective and also generational wealth. Those would be the focuses that we focus on. So yeah.
I'm excited to get into it, Michele. All right. So the way this whole thing, I'll give you all the backstory, first of all, on how some of this got started. Yes. First of all, I want to acknowledge that I am once again in the black t-shirt that Michele is making me wear. But that's besides the point. We had a conversation this week, and a lot of times our conversations during the week spill over into the show for good reason, of course. That's where we're kind of brainstorming, trying to decide what's going on. One of the things I'm always doing is looking at different things that my wealthy clients do. So if you're just joining us for the first time, by day when I'm not in a black t-shirt and I'm in a white shirt, long sleeves, tie, looking all spiffy, I work as an investment banker for high net worth clients. I've been doing this for a number of years. First, I was an accountant, then switched over to the investment banking side of things, sales and trading, all that kind of stuff. So you get to see a lot of money moving around. You see a lot of, you meet a lot of interesting people who are fairly wealthy, and you get to see like the ranges of wealthy, like the levels of wealthy. You have the person who's wealthy, but they're still on that hustle. So they're actively running a company, they're doing the thing, they're creating, they're raising capital for a startup, they're doing that kind of stuff. And they're wealthy, but they're still doing a lot of the initial work. So I call these people the creators. This is my little module, so to speak, or my what do you call the thing, Michele? You're a teacher. What do you call these things? You create your thing to describe something. This is my little 3-step, I don't want to call it a process, but this is my framework. That's the word I'm looking for. This is my framework for rich people. There's a nice LinkedIn sounding word. Doing it good tonight. So my framework. So you got the creators. These are the people who I meet who are doing well, but they are, they're creating the thing. They started the business. They raised the initial capital. And those are interesting folks to meet because they're very close to the center of what it took to create that initial inertia to go, for example, from working just in a 9-to-5 job and making that push into actually creating something, to push past all the no's that you might have gotten from investors in the beginning. They made that initial jump, took that first step out there to risk failure, or maybe they failed several times and now they finally found something that popped off. So I call those people the creators. The next generation that you meet are people I would call the growers. So it can be the case that a creator graduates into a grower, but sometimes it takes a generation because long money takes a long time to grow. So I call these people the growers because they're taking what was started initially and they're now working on saying, okay, I want to scale this business. I saw the mistakes that were made in the beginning. Or maybe I have some new connections. Maybe I'm aware of new technology that's on the market. So these growers now, they take it and they're trying to blow the business up to be something bigger than what it was before. The third tier that you get, I call these people maintenance. Like it's just maintenance and PR at this point. Like they don't necessarily have to be actively involved in the business. At this point, there's a structure, there's a board. They may not really understand the business. They are so far, a lot of times, not all the time, but a lot of times they're very far detached from how the money was made. Now, this can be a pro and a con. Sometimes it's good because then they can really focus on smooshing and networking and closing the deals and making sure they're opening up new opportunities and that kind of thing. But other times, these are the same folks, the trust fund babies you see coming through, and they it's this juggle between building generational wealth, and how to do that without creating idiots, without creating this useful generation, this useful piece of human that's not actually adding any good to the world. I mean, I don't mean to sound harsh about it, but it's like 3 generations in, you see these people and you either get the ones who are very engaged, they understand their role, they understand that they're in their maintenance mode, they just have to make sure they don't mess it up and life is going to be cool. Then you get the others who turn into like this warped version of it where they're wasting, right? They're so detached from the work that took to go into making this happen that they turn into the wasters. So you see this kind of folks going out there. But what I will say is that the common thread through all of this is they're always thinking, when I say they, the creators, the growers, and even the maintenance people, they are always thinking empire. right? The way they operate, like they're thinking their last name, their family unit, like what are we going to build? What is our legacy going to be? They're never just thinking about what they can build in a lifetime. They're thinking about dreams that are so big that they can't build it in a lifetime. Even if they wanted to, build it in their lifetime, they can't get it all done all at the same time. So they start thinking that way. So I want to just start off with that quick encouragement to get us in that thinking in terms of making sure that whatever it is that we're building, right? And I say building because you got to think long term. It's going to take work. Whatever it is we're building, if we want to get to the point where we have serious money, serious buying power, serious ability to call shots and influence what's happening in our communities, in our lives, in our families, and that kind of stuff, you're not going to get it to it's very I wouldn't say you won't. It's very unlikely, and I say unlikely, but Elon Musk, the Jeff Bezos, the outliers out there, it's very unlikely that you're going to be that person. So we got to work, and this is how most wealth was built over time, over generations. It passed down. So one of the conversations I was having with Michelle this week was, yes, we hear a lot of times talking about generational wealth. Great. Talking about passing on the assets, passing on the money. Great. But what about passing on generational skills? And one of my clients, I saw doing this where they're in the what do you call it? There's a fancy name for this. I'm just going to call it the chicken business, the poultry business. But I know there's a bigger fancy word for this. They're, for those of you in the U.S., they're like the Tyson chicken, so to speak, of Panama. To put it in the analogy, so you see Tyson everywhere, or whatever the other competitor is. So you had the father that started it, and now the sons and the daughters come in, and they're running the next tier. So one of is in charge of the actual poultry, the chicken production side of it. Another one is in charge of the eggs side of it. Another one is in charge of selling to other retailers. Another one is in charge of their version of KFC. So you see, they're able to spread it out, spread the skill of quote unquote managing the chicken business, as trivial as that sounds, but they were able to build this up into a multi-million-dollar business and pass on those generational skills, not just the wealth. Because remember, I said these guys came in and they're the growers now. They passed on the skills of managing companies, understanding the know-how how to do this instead of just handing over a check, right? So I want us to start thinking along those lines. That being said, I'll get your input on this, Michele. What do you think? How can I phrase this? There's a situation where we think there's a group of people that think you have to wait until you die to pass on the money or pass on the assets or give access to certain things. Then when I see a lot of my wealthy clients doing, they don't wait until they're 60, 70, 80 years old because they want to. I mean, you have to do this responsibly, of course, for obvious reasons, but they want to make sure that the next generation can start building and get a head start. So they're not waiting 80 years to start. They're starting at 25 years old. For example, I have friends who, it's a very common thing down here in the wealthy families where a young couple gets married. They're not gifting blenders. They're gifting houses. They're gifting a paid off apartment. So imagine the game now when you have a young couple, let's say they're in their late 20s, early 30s, whatever it is. And imagine all the money you spent on your mortgage payment over 30 years. They were able to invest that money in something else, stock market, other opportunities, whatever it is. That's how you start building this generational wealth, right? So I wanted to start thinking on some bigger ideas. Of course, now the conundrum to this whole thing is how to help make someone's life easier for the next generation without making them irresponsible and useless. So I think that's where the training and the morals and all that kind of stuff comes in. But what do you think, Michele? Should we wait or should we give access a little bit earlier?
No, I definitely agree that you should give access earlier. I know I have friends and I know people, and we all had different experiences
Mm.
where they got the great car going into college. So when they graduated from college, they didn't need to worry about reliable transportation,
Yeah,
or their parents or their family purchased them a home and they rented out the rooms and things of that nature. And that way they had passive income. They had
yeah,
their own place that they stayed, but that was also, giving them stability, making sure that they had something just as they move forward. And I do know of the trust funds where they get access to it at 25 as well. So
yeah,
it just depends, but it does come with, yes, growing the business and learning the business and understanding your role to in the business, because they want to be there to give
yeah,
advice and tutelage for them to like be able to carry on the
Yeah.
legacy in the business. So yeah, I mean, that's common for some people and far-fetched for others.
Yeah.
But when you know better, you do better. So it can be anyone's reality if they plan properly for their children.
Yeah, and as you mentioned, planning. I mean, I think that's another thing that we don't see in certain. We see more in other communities, in some communities than others, where this is not a haphazard kind of like you just wait and you die and figure. No, they're going to figure out what's going to happen. No, this has been set up from a long time before. We've seen, especially on the banking side of it. I've had one situation where let's say the father died, and suddenly the kids came like, oh my gosh, here we go. They're ready to just eat up all the money. Like, let's go, write me this check. We're ready to cash out. They didn't know that Pop had the whole thing organized. And without them knowing, he'd already left instructions with his lawyer and the bank and everybody else about what's supposed to be divided and this and that other. And let's just say there were a lot of disappointed kids. Because I've seen stuff set up before in wills or probate documents or trust funds or whatever it is, whichever way you decide to structure it, where there's certain parameters in there. You can leave parameters in there that say, for Michele to get this money, she has to have finished a college degree. She has to pass this drug test consistently for however many years. I've seen parameters in there in these documents before that say this person has to be married for X number of years, and the person they're married to has to be approved by this lawyer. I've seen some crazy stuff you wouldn't think of, but this is the reality of life, where people are like, no. You're not going to come in here and mess up the generational whole situation by marrying somebody crazy. I've seen some serious documents in there that set out how much money they're going to get in tranches. Like, you're not just going to give them the whole mother load all at once. And there are ways that they can fail where they mess up the whole thing. Like, if you do XYZ, this entire agreement is automatically null and void, and you got to go get a job doing whatever. So you can set up these things in very smart ways. I mean, the other benefit to it, of course, if you get into the weeds a little bit, is obviously the estate planning side of it, where you can save a lot of taxes by, instead of passing properties and different things directly to the next generation, you set it up in a trust and it goes through that vehicle, so they get the step up value in the basis of the property, versus having to pay the taxes as if they were gifted. And people don't realize that too. There's actually a thing in many countries called gift tax. So even if you gift somebody something, it's a tax. It can be a taxable event depending on the situation. So you got to really sit down with a lawyer, sit down with an estate planner, and understand how to get those things organized. And don't think of it as, oh my gosh, I'm going to die, therefore I need to get myself in order. This has nothing to do with death. It actually has a lot more to do with life. This is how people who are living with bigger plans move. Right? It's not about what do you call it? You're not tempting death or whatever it is. It's not one of those things. And you also don't have to make these things public. You can set up your stuff. You don't have to tell anybody, but the lawyer or whoever it is setting up, maybe the bank or whatever it is. You just have that document in place. None of the people who are going to benefit have to know what's going on. So let me take a sip of water, and I want to jump into a couple of things. I'm not 100% tonight, but we're going to make it do what it do. I want to jump into a couple of things as we're talking about building generational wealth. A couple episodes ago, we've only had a couple episodes. Maybe the first episode, I talked about the money line concept, and that had to do with getting more aligned on the company you're at with what's actually generating wealth, what's actually driving sales, what's actually producing value for the end user clients. So tonight I want to share briefly a couple of tools that managers and people who are higher level executives, this is what they're thinking, not just counting widgets or fussing about who got a raise. These are the kind of things that they're doing in the offices, in their meetings, when they're thinking about higher level things. These tools are also useful for you if you're investing and you're evaluating a company, or you're trying to do more than just follow meme stocks and what's hot on Instagram or what's being talked about on Twitter, or the first thing you see on the news, oh, let me go buy that, or whatever it is. You can do this in a lot more structured way, without having to become an accountant or a CFA or financial analyst. Some of the stuff it's fairly common sense, and you can sit down with financial statements for a company and do this. And if you don't want to sit down, a lot of these things are already calculated. You can go on to Yahoo Finance. You can go on to some of the sites I'll mention here in a second, the SEC sites, check out their filings, and you can see the numbers already calculated. You just have to understand what that number is telling you. So I want to rock through a couple of them here, Michele, really quickly, just to give our folks water up, knowledge down. Let's do it. All right. So I want to call this section financial analysis for non-financial people, which is really just the stuff that financial people do, but whatever. Let's get
Okay.
into it. So when you're looking at a company, one of the first things you're trying to figure out is, uh, do they have enough money to continue doing what they do, right? This is one of the main concerns. When you're thinking about investing, you're thinking about this stuff, it's on the finance side, it's always forward looking. I don't know what this might be forward depending on which side of the screen. So east, west. You're always looking forward, right? Accountants, and this is I can say this without at the risk of my accounting people chopping my head off. Accounting is very backward looking. Like, you're coming into the end of the year, you're doing an audit, you're trying to make sure that whatever happened during the year was done properly, accounted properly, which is great. It's useful information. It actually feeds that information is fed into what the finance people are doing to some degree. But on the finance side of it, we're not just concerned about what happened last year. We're asking the question, what's going to happen or what can happen in the following year, 5 years, 10 years, etc. So one of the things we look at is called the working capital ratio, right? Working capital. How much money do you as a company have to actually work with? And it's simply calculated by taking the company's current assets and subtracting their current liabilities. And when we say current in these kind of conversations, we're talking about 1 year. So the assets that they have that are planned to be used or can be used in that year, subtracting the liabilities that are due in that 1 year. So to make that simpler, if a company has a $10 million loan, but they're only due to pay back $1 million this year, we're not worried right now as far as working capital ratio about the other 9 million. We're only talking about the 1 million. Like, do they have enough liquid assets, so to speak, and when their current assets to deal with what they have to deal with this year? Are they going to die within the next 12 months? This is what we're trying to figure out here, to put it in a really light kind of way. So working capital ratio is very interesting to think about. Executives look at this, not just investors. You're looking at this all the time to make sure you can forecast whether you'll be able to be a going concern going forward, and make sure you have enough capital to do what you got to do. An offshoot of this is called the quick ratio. The quick ratio is sort of doing this the same way. So I'm sorry. So working capital is a subtraction. If you want to get the ratio, you divide the two, right? So current assets divided by current liabilities, just to end that point. The quick ratio is similar to this, right? Similar to the working capital ratio. The difference being, in those current assets, the assets that they're going to use in that first year, you're going to take out from that, you're going to subtract inventory. So you're looking at all the current assets except inventory. And why are we taking out inventory? We're taking out inventory because the idea is, well, you have inventory, but let's say you have a bunch of stuff. Let's say it's a company that doesn't turn over stuff very quickly. Let's say you have a bunch of, I don't know, you have a bunch of metal, you have a bunch of concrete blocks, you have a bunch of whatever. The idea is that inventory may take more than a year to turn, to sell, right? So I don't want to, if I'm doing a quick ratio, I don't want you inflating how much stuff you have available with inventory. I want to take that out. I want to see just the real stuff that you have available. If you had to sell this today, the company has to go down altogether, whatever it is, could you deal with your current liabilities for this year, not just the inventory? Because somebody's not necessarily going to come in and buy all your inventory tomorrow or this year. So you want to take that out. So it's a little bit of a working capital ratio with a little more pressure, right? The next one you might have heard bouncing around is obviously earnings per share. We hear this a lot, EPS, earnings per share. And this is simply the net income that the company made divided by the weighted average of the common shares outstanding during the year. Now, I know that sounds like a mouthful. So the net income of the company, obviously, how much money did you make? Like, income minus expenses. Pretty cut and dry. That's what it is. When we talk about the weighted average common shares outstanding during the year, during any given year, obviously you see on the stock market, people are buying, people are selling. Stuff. The company might be buying back shares in a share redemption kind of thing because they want to, maybe they buying it back because they want to purchase some other company with shares. So the number of shares outstanding, as in the number of shares that are out there in the wild, owned by somebody else besides the company, that's going to fluctuate throughout the year. So when you're calculating this, when you see this number, they're taking the weighted average of all those ups and downs, and they're dividing the net income by that to see, all right, this is the earnings that we're having per how many shares. So if each common shareholder, each one shareholder or holder of one share had to get a piece of this net income, how much would that be? All right. So that's what you're thinking about there, to see how rich is each individual shareholder per stock or per share. Another one that's interesting that you hear bouncing around, especially on a Monday, right? And I say on a Monday just because markets are opening on a Monday, like tomorrow morning, even before the markets open, right? You hear these conversations happening, is the price earnings ratio, right? And it's literally that simple: the stock price divided by the earnings per share that we just talked about in the previous spot, right? Just now, previous point. So you're thinking the price of the share that you see in the stock market, if it was $50 per share that it closed down yesterday, and the earnings per share was $10, 50 divided by 10, you have 5. Boom. That's kind of your PE ratio you're happening there. And this is kind of considering or trying to understand how much the perceived value in the market of that stock is really how it relates to the actual earnings that they're making. Even more interesting though, if you really want to impress your manager or whoever it is in the company, you want to sound impressive in a meeting. Price earnings ratio, all right, intermediate level. You want to start talking about the forward PE. And this question, remember I said finance is not just talking about what happened right now, it's not talking about what happened before, it's talking about what's going to happen. When you look at an investment, you look at a company and you start talking about the forward PE is not just asking the question about now. It's a reflection of what the markets, what investors are expecting the company to do, right? What are we? It's here now, but where do we see it? Because you can see situations where a company will have a great PE ratio. Oh, this is an amazing company. When you look a little bit deeper, the analysts already realize like there's a key man risk where the whoever is the head of the company and is wrapped around their whole personality has announced some kind of health challenge, or the board is upset with him because he went smoking weed on Joe Rogan's podcast, or whatever it is, and they're pricing that in going forward. Somebody might have caught who I'm talking about. They might already pricing that in going forward, and they're saying yes, the company's doing well now, but based on this trajectory, based on the pandemic, based on supply chain issues that we're seeing, based on chip shortages, we're not sure 12 months down the road if they're going to be able to maintain this. So you can have a situation where PE ratio today is good, forward PE, looking forward, is not that good. So you want to consider those two calculations when you see them out there. And again, this is not that you have to go super geek and calculate all this stuff yourself, but the more important thing, especially if you're a quote unquote non-financial person, your finance department, your accounting department, they should be able to get you this information as an executive. The more important thing is for you to be able to understand what's happening and be able to interpret it. A couple more real quick is your debt to equity ratio. This is an interesting one because it applies not just in the company perspective, but this also applies when you're going to apply to a bank for any kind of financing. If you're trying to get a loan for a house, a car, a line of credit to start your business, a startup loan, whatever it is, and it's asking how much debt do you have compared to how much equity, right? The valuable stuff, book value, stuff that you actually own. What is the ratio of that, of those two things? And if you're talking about banks, sometimes they'll also call it, in a loan perspective, they might do what they call a loan to value, which is a kind of related kind of thing where they're looking at how much loan they're willing to give you based on the value of the property. I know I'm kind of mixing two things, but I just think it's good to think about these in parallel. So that debt to equity and loan to value, it's asking the question again, how much valuable stuff, if we had to sell off all your stuff, if we had to sell off everything that you actually own clean and clear, how much of that is available to cover the debts that you have, right? If all hell broke loose and we had to shut it down, can we sell off all your stuff, bankrupt you, and still be able to pay off everybody? So that's what your debt to equity ratio is thinking about. The loan to value one is relevant in this conversation just because it's thinking about if you have a property or whatever it is that you're trying to buy, and that property, let's say for easy math, it's $100,000. They're looking at how much loan, right? Are they going to lend you 40,000, which would be like a 40%, 50,000? What's the loan to value that they will give to you? So just think about those things in parallel. In general, if you're looking for a general number, and you check with your bank for this, I'm not your financial advisor or your loan officer. These are my disclaimers. This is why I'm talking very fast. Check with your actual bank. But as a general guidance, what I've seen a lot of times, more conservative banks, they'll want your kind of debt to equity, or your, how would they want to put it, your expenses ratio or whatever it is. They want that to stay under 40%, right? So that's what they're kind of looking for in terms of how much money you're making compared to all your different bills and the different debts and things that you have to pay on a regular basis. Last couple of them, and then I'm out of here. If you're looking at a company I'm gonna skip over. Okay, I'm gonna skip over return on equity. It's a similar thing. Net income divided by equity. Similar kind of conversation.
Okay, before you go on to that, I just have a
Yeah,
question.
go
So
for it.
for the non-finance people, my takeaway from what you're sharing is whether you're an executive or not, this helps you assess where you are along the money line, which we have talked about on each episode. It
Yeah.
helps you also to help you have an understanding of where how you impact the business and what you can work on to help increase revenue, just be able to understand the conversations that are taking place. A lot of people, if you're working in a 9 to 5 or you there's always notices of what's going on and you just have your own understanding.
Yeah.
And if you're looking for a job, the benefit of understanding this, or if you're looking at a new company, beyond the culture, beyond who you're going to be working with your team, the the stableness of the company you're working for
Mhm.
and what's important to them, it all shows in their financials.
Yeah.
So that helps you determine if they're in line with their mission according to your interpretation and what resonates well with you as well.
Right.
So understanding the terminology is always good, and repeat and hearing it over again if you're not a non-financial person is
Hmm.
good, just from a basic understanding, because you're developing your just understanding business acumen at a heightened level for some people, or just continuity for others. But it's just always good to understand how it all flows together, because Dallin just shared a lot of fantastic insight. It's
Yeah.
like, okay, how do you break this down to make it apply to you, and
Yeah.
why should you make it apply to you?
Yeah. So I mean, this stuff, like I said, it sounds like a bunch of technical things, but you're not gonna make it up on the money line without talking money, right? And this is how money sounds, right? It doesn't sound like fancy cars. It doesn't sound like fluffy. Oh, we're gonna grow the company. We're gonna do great this year. Great is not a financial term. Like, what is that? What is the actual turnover rate that we're trying to get to? So I always tell people, approach this just like if you were learning another language, right? Just as if you were learning another language, you got to learn some new vocabulary, and don't feel bad if you make some mistakes at first, if it's not as fluent. You got to open your dictionary. I mean, I've seen professionals all the time. We have Investopedia open on the computer during the day. You got an app on your phone. There's no shame. I had a professor that said, college, you got all these tests and everything, but life is open book. I mean, you can look it up. Do what you got to do. Make sure you get the right thing, but you can look it up. But this stuff makes a difference when if you're trying to apply for a raise, if you're trying to raise capital for investors, savvy investors, these are the kinds of questions they're going to ask. For example, if you're talking about, you say, oh, we made about $10 million in sales this year. A savvy investor is going to say, okay, but show me your accounts receivable aging. And you don't want to be looking at like a deer in the headlights, like, what are they talking about? They want to see, you said you made $1 million in sales. They're like, how much money did you actually collect though? Like, is that on credit? And how long do people normally take to pay you? Because you can look down in the financials. When you see a big sales number, if you go down a little bit, a couple pages in, 10, 15 pages in, you usually see an accounts receivable aging table that shows you these are the people that owe them money and they're 30 days late, 90 days late, 120 days, 180 days, and the people they don't think are ever going to pay them. So you can see if a company is in trouble easily when they have a whole lot of money that's been out there on the street waiting to be collected for more than 180 days or whatever the norm is for that industry. So this is where you can make more insightful comments or questions in a meeting and say, when somebody's like, oh my gosh, this company is great, we should definitely go down the road. You can be like, wait a minute. I think they have some collection issues. I think they have some credit issues. There's something deeper that we need to consider here. And then the last one I'll just show out there is,
Wait, before you go to the last one, so those that are consultants
yeah,
or solopreneurs or small businesses, and you're
yeah,
determining who you're going to work with, who
mhm,
you're going to partner with, or if you're a consultant and you're pitching your services, these are all, like, I would say, replay this interview, well, not
yeah,
interview, but this session, and take notes and cultivate in your questions that you're going to ask a future client, or you want your clients to ask people that they're going to work with. Do
exactly.
their level of understanding, and also where do they fall in that and their interpretation of it. That's
Yeah.
another good way to determine synergies
Hmm.
when working together, and making sure you're on the same line of conversation of
Yeah.
understanding of the next steps that you're building together.
Exactly. It come to the understanding of what's acceptable for you. What's the but not like not in general terms. Like what is the number that is actually acceptable to you? Let's talk, talk in the actual language. So those are some things I want to throw out there. I mean, we can go on and on talking about a whole bunch of different stuff. The last one I'll just mention for anybody that's seriously evaluating a company, whether it's your company, somebody else's company that you're thinking of investing in, is to have a look at the cash flow statement. A lot of times people want to jump to the easy one, the net income, the income statement to see, hey, did they make money or not? Great. Or we want to look at the balance sheet, like how much do they have in cash, assets, whatever it is. That's great. But the cash flow statement is an easy way to look at what did they spend money on this year? What are they spending money on? What are they doing? And the simple explanation is this: it's broken up into three sections: financing activities, where they're getting loans or they're raising capital or they're raising finance; operating activities, which is doing the actual work, the actual business, whatever they're in the business of doing; and then investing activities, like are they acquiring a new company? Are they building a new factory? Is there like a capital expenditure going on? So you can look in there really quickly because they'll break it down and see what the company is really up to versus just looking at, oh, last year they had a lot of the cash, this year they didn't have any cash. That's great, but what did they spend that money on during the year? I think that's really, really, really useful. So those are the tools I want to throw out there. Of course, if anybody has any questions about them, feel free to jump into we don't jump. Feel free to slide into the DMs financially and let me know what's on your mind. Other financial experts out there, if you have other metrics and that kind of thing that you think are crucial, feel free to drop them in the comments. I know there's a whole bunch of them out there. We couldn't talk about everything, but that's what I want to share tonight as far as getting us closer to the money line and understanding how to talk the money language.
Yeah, and I think that that was a great education that you shared because it's not only great for those on the business side, entrepreneur, small business, wherever you are, if you're an executive managing it for a corporation or you're building your own, but also, like what we mentioned earlier, if you're navigating your career trajectory or just trying to just understand the business as a whole, these are great insight that you were sharing and educating or re-educating or reminding, depending on
Yeah,
where that person is, whoever's listening or watching how that can just it might trigger something for them to remember. So that's awesome.
awesome. So that's my part for tonight. This is what I want to share. I know you got some good stuff for us. We've been talking back and forth about your stride narrative and seeing the stuff on social media. Break it down first, Michelle. What are we talking about with your narrative?
For sure. So just to remind everyone, my name is Michele Beatty. I'm a project manager by day, and then at night, I'm in the internet streets promoting professional development for everybody. I think this is going to be a year of thriving for everyone. My word this year is thriving, like
Internet
hands
streets.
down. It's true. I mean, we're constantly on LinkedIn, or I should say social media streets. We're, just
Yeah.
digesting, consuming information all the time. And so one thing that came to me last year was keep your stride. When I was debating whether or not I was going to continue on my work in the professional development space, and it just came to me, yes, you have more work to do. So keep your stride. And I broke down stride to stand for stats, teachable, research, intentionality, development, and engagement. We spoke of engagement in episode 1. And then today I want to talk a little bit more about stats and being teachable and how they
Okay.
intertwine, because for a lot of us, we are navigating processes at work, right?
Yeah.
Hands down, we're executing. Processes are all about execution to accomplish a goal. So what is that? And we all have different ones going on. Some are associated with our role, and then some people are just trying to always keep the door open when they're going through the interview process. So what do you need to remember when you're doing that? And one thing about keep your stride, it's a cadence, right? It's a cadence of keep going no matter what.
Mhm.
Whether you get weary, you pause, you take a breath. What does that look like? And that happens with all of us. If we're in the workplace and we're trying to figure something out, or we hit a roadblock, it's like we have to take back, we have to step back, we have to assess what's going on. So what does the assessment look like? And that can come two ways. One, assessment of self, right? And then also assessment of the environment that we're in regards to execution, milestones, and just are we taking everything off on our checklist, on our what are we covering all the bases, and how well. I think quality comes in because you're also analyzing quality to negate risk. So there's a lot of combinations of things going on. So one thing I really always encourage from a self-assessment and a keep your stride stance is can do a SWOT analysis, strengths, weaknesses, opportunities, and threats. I look at threats more so or opportunities as areas of growth. So that can be like, for example, you're executing your project, you're dealing with 7 people on a team, for example, and you have different personalities you're dealing with, different communication styles you're dealing with, and no one's looking, and you're like head on base. You want everyone to look at the artifacts. What did we do historically? What got us to this point? And that helps you keep everyone focused on accomplishing the goal despite communication. It's like you can always bring it back to this is a scope, this is what we're working to accomplish, and based off of artifacts and looking at our logs, we can come back and say, okay, this worked, this didn't work. Let's try your input here. Let's try this here. At the same time, let's take a notation of what should move forward. So that happens at any given time throughout any journey, a problem that we're solving or a goal that we're achieving.
I got 2 questions. One,
Yes.
with the SWOT analysis, are you talking about doing it on yourself, on individual people in the team, the overall project? Like what or all 3 of those? I don't know. And secondly, could you just explain what you mean by artifacts?
Sure. So I think I perceive the SWOT analysis can be done when needed. So on yourself, if you're struggling connecting with the goal or with the task given to you, you have to uncover your disconnects. What is that for you? Why are you disconnecting from it? And as far as a team, and it's not flowing, you're not meeting deadlines or the quality of the work is not there. Okay, why is that? So an analysis, and that's just it's a traditional form of analysis that can help you. And as far as artifacts, it's in regards to historical, like what's done in the past, like your backlogs. You would say the cash flow, like where would this be? But for myself in the project management world, that could just be the logs of what's done in the past. How do people do it? What were the wins? What were the takeaways? And what were the lessons?
So you're trying to find whatever. Correct me if I'm re-explaining this the wrong way. So when you talk about artifacts, we're trying to find useful data points from the past that can help inform what we're trying to do to improve processes now.
Right.
Is that a good non-PMP explanation?
I think it's a fantastic explanation. And I think it's also because you want to repeat what was good and learn, and you want the lessons to remain lessons and not be repeated lessons, because you want to, continue on to move forward. So there's always a process review. But I also feel like from a personal standpoint, as a lot of us we're in Q1, we're entering, well, not all the way, we're like mid Q1 of this year. So like the newness of the new year is kind of like dying down. The reality of like, okay, we got to make these numbers. Our work environments are constantly changing because we're all going through a pandemic, and just world as we know it is different, hybrid, remote, whatever, all these different factors. So that's where I think we're having a process that you stick to, that's your guide, can really help you stay consistent with thriving, right? Regardless of the environment, even if you're tired or you're shaken or however the case may be, or you just, getting kudos beyond kudos, how do you keep your stride to do that? So that's reviewing your processes, and that's staying informed. You have to stay informed. I felt like you were about to ask a question.
No. I'm soaking it all in. I have no shame about interrupting. I will interrupt you. Trust me.
This I know. So staying informed. And then I feel the biggest part of not the biggest part, but a key aspect of staying informed comes down to you being teachable. Teachable when it comes to your perception. One thing I used to really, when I worked in big box retail, was perception is reality. Like that sentence used to just make my skin like, because then you're forced to like embrace what others are saying, right? You're embracing the unpopular opinion in your mind, regardless of what's evident as you're like
Right. So
moving
like if
forward
this
with,
is what they're saying, regardless of whether I think this is complete BS, okay, I guess it's valid because it's what they say they're seeing, even if I totally disagree.
hey, perception's reality. And there is truth in it, regardless of you wanting to embrace it or not. There's something that you have to course correct in regards to your messaging, in regards to execution. And you know, it's almost like if they took a picture of the situation, like if you're an athlete and the coach will say, run the tape. And the player can be like, Coach, I didn't do that. They're like, what does the tape say? If I play back the tape, what does the tape say? You know, so for my sports folks, like tapes, the videos don't lie, right? So
Yeah.
what did you do? What did you not do? What was your body language?
Yeah.
You know, things of that nature. So you have to be teachable, even if you're teaching yourself. Like, I need to rethink that. Like, I was speaking with a colleague this week about something, and our takeaway was we need to embrace a communication that's different than our own. And we thought that we were doing great, but in actuality, it was like an aha moment. So that's just one example of many, but you got to be teachable.
Yeah.
And you have to be open to changing the process as needed. And I think sometimes that can be hard for people, like embracing that. So that's when you come into leveraging your SMEs, your subject matter experts, your communication, and things of that nature. I think it's very important when you're keeping your stride, even if you're assessing yourself or you're a part of a team and you want to be viewed as a strong contributor. You might see yourself as a strong contributor, but in order for your team to see you as a strong contributor, you got to know your stats. You got to be able to communicate your stats. You got to be able to tell the story of your stats, right?
Mm-hmm.
And in the meantime, being teachable. So that could be your communication. That could be learning something new. That could be learning a software. And I know like a lot of people, like many people that interact with us, send us DMs and things of that nature, they're high achievers. There's no doubt about it. They're amazing folks. They're high achievers and they're on their game. They're like, I am a leader. But even leaders get tired of, you know, I just went through like someone, you know, they could have just gotten, for example, they could have just gotten their PMP. And then someone comes like, well, you need to get this other certification. It's like a gulp moment. Like, what do you mean? Like, I just got this one. And now you're talking about I need to go get another certification.
Coming up with more stuff.
Yeah. Or I need to attend another class. And it's like, you have, you know, leading and being a strong contributor and just being a person of value in your workplace, you're always in student mode, no matter how you feel about it.
I mean, I think the underlying point here, this should be a moot point, but I think the underlying point here is also, especially for small business owners or people seeking to grow their business from it being where they own a job to the point where they own a business. You're talking about reviewing processes. I think we need to actually mention that you need to have actual processes, because we can get busy just doing the stuff, doing the tasks, especially when it's something you're good at and you just fluent at it. You just do what you got to do. That's great. But the only way you're going to free yourself from having to do it all the time or be able to scale it to where you have more people doing that and you can be doing more high value things is by actually having the process, taking the time to document it. And that way you can do what you're talking about here with the process review, where you can know which dials to tweak, like which part of the process is good, which part is bad. You can only do that when you actually documented it, all the little steps, all the little ins and outs, even the stuff that seems intuitive to you. You want to have those kind of things documented down. I had a situation in the office a couple of weeks ago, I think it was, where we needed to make a change to something because something wasn't working the way something was getting done. And afterwards, someone came back and said, hey, this new way we did it worked really well. Let's make sure we contact the processes department, or what are they called, and have them formally tweak the process. Because this whatever we did this time, it saves a lot of time. It's more efficient. So I think it's important to just have actual documented processes.
Oh, I totally agree. And that's one way, if you can give it to, if you do something, you're the SME for your team and you need to train a backup or you need to train someone else because you're moving on to another project and you're like, here's all my written directions, right? Directives on how to do it. Can they follow it and do the same thing? That's the test. Like, that's the magic of do you know what you're doing and did you properly document it to your point?
Yeah.
Are you
Can you teach
passing
it?
on? Yeah. Is it cohesive and is it comprehensive? So what does that look like? So yeah, I totally agree with that 100%.
Maybe the problem is that if we document the process too well and make it easy for someone else to follow it, we're kind of, what about the person who says, well, that way I'm documenting myself out of a job, I'm making myself unnecessary.
No, I don't think that at all. I think you're just showing yourself as a strong contributor, because the great thing about it is you want it to run effortlessly, right?
Mhm.
So when you do hand it over to operations, it's not like, oh, well, what happened to this? Like,
Yeah.
it was well documented. So no, I just think that's just not the right, my personal opinion, I don't think that's the right mindset to have.
Yeah.
You want everyone to be informed and know how to do something. And you want people to feel empowered, because that goes back to morale, that goes back to team building, that goes back to longevity in a role. There's so many things that impacts that. And what does that mean? So again, to make it personal from a keep your stride standpoint, all of that helps you be able to keep your stride and not get weary, and know that you have people that you can rely on that are qualified, knowledgeable, and they understand what it takes in order to make something a success of accomplishing a goal. And I
Yeah.
also want to say, like, I talked to some people, I've talked to someone this week, and they're like, Michelle, writing is not my strength. I'm like, okay, so subscribe to Grammarly,
Yeah.
like, invest in resources that can totally help you excel. Like,
Yeah.
there's so many software programs out there now. Don't be reluctant to invest in that in order to help you become successful in what you need to do.
Yeah, or have someone who proofreads your stuff. I mean, whether you go on or Fiverr or whatever it is and get someone to proofread, or you have a confidant, a friend who can, assuming this stuff is not super confidential. Hey, can you read it? We do this. We do this on my team all the time. Like, we will draft an email and send it around to the team first before we send it out to the public or whoever it is, the client or whoever it is. Like, hey, what's your read on this? How do I sound? Do I sound upset? Do I sound like sarcastic? Whatever it is. Do you understand? Or sometimes we'll send it blind, like, hey, read this. What's it about? Just read it. And you tell me what you think it's
Mm-hmm.
about. And let
Yep.
me hear the explanation to see if I was getting my point across. So yeah, don't be afraid to do that kind of stuff. I find the people who are sharpest and the best, they are, of course, it depends on the team you're in, but it's really good when you're not afraid to, I guess, show your vulnerabilities or work in a collaborative environment. And the other good thing about doing that is when stuff goes wrong, it was everybody's fault. Well, I wasn't the only one who saw it. We all had eyes on it before. So you can actually loop people into the failure as much as you loop them into the success. I think that's a good way to approach it as well.
Oh, for sure. And one thing about stats that I did not touch upon is recording your wins. Like, yes, your lessons, but record your wins, because that helps you have the momentum. And your projects, yes, record what the team did well, right? Or if
Yeah.
you're a part of something, record the team, but record what you did well too. Not
Yeah.
just for your reviews, if you're part of a company that does reviews, or if you work for yourself, it's not necessarily applicable, but it shows you where you've grown. It shows
Yeah.
you what you do well. It helps you uncover something that you might not realize that you do well. So I think it's a great way of discovery.
Yeah.
Discover what skills you excel at, and then also it helps you gauge, like, where you are: novice, moderate, expert, room
Yeah.
for growth, meaningful, things of that nature. So it just helps you gauge yourself so you can be the strong contributor that you're aimed to be, or you perceive yourself to be. And if that comes back into question at any given time for any given reason, then you have your own list to go back and check. Well, I did this,
Yeah, you
this,
got
and
your
this.
receipts.
Yeah, I'm all about receipts. You need your
Yeah.
receipts for your, because people want them.
Why you said that with an attitude, though? I don't know. I feel like you had a little extra. People want them.
People do want receipts. They're going to scroll through your timeline to see, well, when did she say that? When did she do that? When did that happen? And
Yeah.
it's great to have it like a portfolio. It's just more intense now, more magnified now, because everything is so accessible for different reasons for people. So yeah,
Yeah.
receipts are important.
Receipt. There's receipts and there's receipts. What?
Okay.
This is medication talking. I'm sorry.
Yes, Dalan does not feel good, but he pressed through. So we're forever grateful for that.
Oh man.
Yeah. So I just want to share, I had a great Skills Recharge interview this past Friday with Banzi Yelsangi on
Really?
Sprint Your Way to Scrum. It was a great interview. And if
Is that
you are,
replay still on your page? Is that
it is still
still
on the page.
okay?
Yep. It's not taking it down. So it's on the page wherever you are, YouTube, LinkedIn, Facebook. And then
Yeah.
I also uploaded it to Career Tipper as a bonus episode. So
Okay.
if you're wanting to understand Scrum, Agile, it's a great resource for team building. And it's also a great resource if you're just trying to understand Scrum, if you're trying to decide if you want to be a certified Scrum Master. I'd say it's a great investment. Bonzi is offering 20% discount for anyone that's watching that's interested. You can go to that interview, click on the link, and you can get the book at a 20% discount. I think it's a great investment for team building, for understanding. It's 50 questions and answers about what you can encounter in a Scrum environment and how to approach them. And it's a great stretch. If you want development, it's a great tool to use for self-development or team development.
Groovy.
Yeah.
So make sure y'all go check that out. I know we talked about a lot of stuff this week, a lot of different terms and all that stuff coming out. But remember, always the replay will be here, wherever you're watching this, YouTube, Facebook, wherever it is. So go back, get your pen and pencil out. You might be in your pajamas tonight, just kind of watching it on your phone with the, on the bed with the phone right here, about to fall asleep or whatever it is. But go back, check it out, take some notes, and hopefully something out here is useful to you or something that inspires you to do more research and go down that path towards building more money, time, and freedom. From my office here in Panama, I'm signing out, encouraging you to stay profitable and have a powerful week.
For sure. And thank you for those that logged in while we were live. We appreciate you being here with us. And I'm Michele Beatty. If you have any questions about professional development when it comes to your keeping your skills recharged, competitive, and hire ready, please DM me, message me. I'm here to help. Want to know what you're working on. And just remember, we're here to help you to keep your skills recharged, competitive, and hire ready. Thanks so much.